Good morning fellow degenerates. A new day with new opportunities on the stock market. Let's start with some position updates. Yesterday, we added a new position to the Momentum portfolio. Daktronics was the stock that made it in after the company delivered a report that exceeded market expectations and sent the stock soaring. We bought in at $12.66 and sold half the position at $14.05, almost the daily high, after a good rally. I almost wonder if I sold my shares to Cathie Woods. AstraZeneca was one of the setups I highlighted in yesterday's market update as interesting. During the day, the stock was up testing the previous highs but didn't manage to break through this time either. This was the fourth time the resistance was tested. It's often said that the more times a resistance or support is tested, the weaker it becomes. If this holds true for AstraZeneca, the resistance should be very weak now. When reading that resistance weakens the more it's tested, it might sound like hocus pocus. But overall, it's very simple. When a stock like Astra is sold off at the highs, it means sellers have the upper hand at that level. There are simply more sellers than buyers. Sooner or later, everyone who wants to sell their shares around 1,697 Swedish kroner will have done so, and the stock can then break out for real. Whether, when, or how this will happen for Astra remains to be seen. In the US, it was mostly the big tech giants that delivered on the upside. Amazon and Tesla, which had almost been overshadowed during the recent AI hype, were two of the best performers. Amazon broke out of its flagging pattern and recorded new all-time highs yesterday. With this move, Amazon climbed above $2 trillion in market value for the first time. Amazon now joins Microsoft, Apple, Nvidia, and Google in this unique club. Together, these five giants have a total market value of $13.8 trillion. To put that in perspective, it's 3.45 times the size of Germany's GDP. Tesla also broke out yesterday, and I see it as likely that the price will head towards the next resistance level around $206. In fact, all of big tech is interesting right now as the FANG ETF broke out again and set new ATHs yesterday. ICLN, the green energy sector, came down yesterday and retested its falling trend. I find this a very interesting level as we still have an active swing here. I plan to increase my position slightly today. It probably won't be a huge increase, but the idea is to increase the size by about 10%. The rally among tech companies, however, stalled after the close when Micron Technology released its Q3 report. Micron, the third largest manufacturer of memory chips, reported results that significantly beat market estimates. Revenue grew 81.6% year-over-year and 16% sequentially from the previous quarter. Micron made a profit of $332 million compared to a loss of $1,896 million in the same period last year. Looking forward, the company expects continued strong growth and guides for revenue to grow by a whopping 90%. Despite beating estimates and showing strong year-over-year numbers, the stock fell 8% in after-hours trading, dragging the entire semiconductor sector down. The stock has performed well this year, up 66% in 2024. Expectations for the semiconductor sector are high. What's interesting is that the stock fell so sharply on this strong report. When we see stocks fall on strong reports, it's often a warning sign and a bit of a top signal. Is this a preview of how the majority of semiconductor stocks will be handled during earnings season? It's a very slow period on the stock market right now. You can tell that many have gone on vacation. Volumes are low, news is scarce, and after 10 a.m., nothing much happens on the stock market. So, instead, I spent large parts of the day screening for stocks. It's always a way to kill time. Below, I did a simple buy and hold screener. Here, I try to filter out companies based on fairly strong growth in revenue and profit over 1 year, 3-year, and 5-year timeframes. I like to use a relatively long timeframe to filter out companies that may have done well for just 1 year. Good companies that manage to grow every year often continue to be just that, good companies. I set the minimum growth rate to 10% annually, but you can play around with all sorts of growth rates yourself. As you see, most of the companies grew much faster than just 10% per year. Next, I set the PE ratio with 5 as the minimum and 30 as the maximum. This is to remove anything that is highly valued and to remove the lowest valued ones. You might wonder why I remove the low valued ones. Well, if you find stocks trading at PE 3 or similar, in 90% of the cases something is wrong. For example, May Pharma was on the screener before I set a minimum level. The stock is currently trading at a PE of 0.7. But looking at the forward estimates, The company is expected to go from earning 3.62 per share in 2024 to making a loss of -5.69 per share in 2025. I know nothing about the company, just going by the estimates. But as mentioned, there is usually an obvious reason why a stock looks dirt cheap. Always be extra careful if you come across something that looks insanely cheap. In the next step, I also looked at net debt/EBITDA, which I find gives a very good indication of a company's indebtedness. I usually set the ceiling at 2.0 or 2.5. Why? Net debt, this is the company's total debt minus cash and other assets that can easily be converted into cash. It shows how much debt the company has left after accounting for the assets that can be used to pay off the debts. EBITDA, this stands for earnings before interest, taxes, depreciation, and amortization. It gives an idea of the company's operational profitability, independent of how it is financed, debt or equity, and accounting techniques. By dividing net debt by EBITDA, you get a measure of how many years it would take for the company to pay off its debts with its operating profits. If a company has 2 in net debt/EBITDA, you can say it would take 2 years to pay off the debts, if that were the only thing the company focused on and all else being equal. The higher the number, the worse it is. The lower the number, the better. For me, net debt/EBITDA can preferably be negative. Then I used ROE, return on equity, a profitability ratio that shows how profitable a company is relative to the equity that owners have invested in the company. It helps us understand how effective the company is at using its equity to generate profits. For example, if a company has a ROE of 15%, it means the company generates 15 cents in profit for every dollar of equity. ROE is one of the few fundamental metrics, besides growth, that has a strong positive correlation to positive stock performance. After running this screening with the metrics I just went through, we get only 40 companies in the US that fall within the parameters, out of 16,214 possible on my data provider. Quite impressive. On my Patreon, you can access the full list of stocks and learn more about each metric I screened on. Regarding today's macro, GDP figures and initial jobless claims are expected at 8:30 New York time. We can expect some action here. That's all for today's video. Please give feedback on what you think, otherwise like and subscribe so you don't miss upcoming videos. See you tomorrow.